Dear Liberated stock traders, welcome back. This is Barry Moore from LiberatedStockTrader.com, and I've recently been inspired by one of my clients who's receiving mentoring sessions with me at the moment. He is a long-term investor. So we looked at his investing strategy and it looked pretty clear that he is someone that will buy on rock-solid fundamentals and hold for a long period of time in the hope that the stock market will be rising and his stocks that he's well selected will outperform the market. And because we discussed this, I am going through a series of sessions with him to look at long-term market analysis, reviewing how and when are the best times to be in the market. He was stung in 2000 and again in 2008 pretty badly. He remained in stocks throughout both of the bust parts of our business cycle. And so I started discussing with him about using long-term moving averages, and I also wanted to share today the use of Fibonacci retracement over a longer period of time. So you can see here, for example, I'm using the S&P 500. I have here a 200 bar moving average, as you can see here, this white dashed line, and you can see the market is from the year 2000 through to the bust of 2009. Now, simply put, if we look at a long period, and this is a weekly chart, you can see here, we can see that price, with the 2000 dot bomb bubble burst, you can see here it burst just after mid-2000. If we had a trend line there, we would have seen the break of the trend line here. However, you can see price actually of the S&P moved down through its 10, 50 and 20 day, or in this case week moving average around about here. However, if we use a 200 moving average on a weekly chart, it's a 200 week moving average, you can see here that price crossed down here. And with the S&P 500 or any index, when you look at it over a long period of time, you see there's not too many periods where the actual value of the index will cross through the 200 moving average on a weekly basis. You can see here there was really a very strong confirmation here at the beginning of 2001 that things are looking pretty sick, and the market continued down through the 200 moving average for the next 2 years, where it bottomed just about here in 2000 to early 2003, and the market started going up. One of the downsides to this is that if you use a longer term moving average, then if you were to use that as a buy signal as the price moved up through the 200 average, then you would have missed all of this gain here. So to get back in, for example, we could look at the 10, 20 and 50 week moving averages, and this could have potentially been a buy signal right here, which would have allowed you to capture most of that gain. So even if you're a long-term buy and hold investor, the long-term moving averages, for example, can be a very good guide that things are getting pretty poorly. And you can see here throughout from really mid-2004, as price moved up, we had a very strong surge, quite a good recovery, back to and slightly exceeding the highs of 2000. And then what happened here in 2008, you can see that the S&P moved back down through its 200 bar moving average, 200 week moving average, and you can see here that the market plummeted. So even using the most basic technical analysis, if you're holding for the longer term, does make sense, even if you use a 200 moving average on a weekly chart. And this is pretty much a 10-year view that I'm showing you here. Of course, you can get a little bit more focused and use short-term moving averages. However, they're prone to a few more false signals. As you can see here, there would have been a false signal here, here, and but you would have gotten out earlier here. So it's a little bit pros and cons, but if you're holding for a long period and the market is going to go through an absolute collapse, as we have seen here, then no matter how good the stock you've got, you're pretty much going to lose money during this period. So it makes sense to be in cash. just remember you don't have to be in stocks all of the time. Okay. So also you can see here what we have is the MACD, this white histogram here along the bottom, and that can show you essentially what the fuel is in the tank, and that's the moving average convergence and divergence. So that's how the moving average lines are converging together or diverging in a positive or a negative way. And an indicator that I like to use is the RSI. You can see this in red, and the moving average 14 on the RSI, and that's quite a good signal. You can see here, for example, when the 14 bar RSI crosses through the 14 moving average, you can see here, hopefully you can see that on the screen, then that is especially when it's in a deeply oversold position, as this is, anything under this line here is oversold. And you can see essentially right here the RSI 14 crosses up through the moving average of the RSI, and you can see MACD swiftly changes into positive territory, and that's pretty much just before the bottom. If we track where that happened here, you can see that actually the signals start going positive here, and yeah, there is some more downside, but you can see then we start seeing a strong positive divergence in the indicators. So if we move on a little bit to more recent period, we can go through to present day today, and we can make this a little bit more detailed. So we're going to just go here. We're going to go from 2007 to 2011 up till today, and you can see here we're still on the weekly chart, and we have the 200 moving average here. And you can see something quite interesting has recently happened here. We have the price of the S&P 500 has moved since the crash 2009, has actually now moved in the November-December time period of 2010 above this white dashed line, which is the 200 moving average. And that's a positive signal. But we have to understand right now, we can see that the market is stalling somewhat, it's getting somewhat oversold. If we have a look at RSI and MACD here, you can see MACD has moved considerably negative since November timeframe. And you can also see here, if we look at the MACD, although price has gone up over this period, MACD is showing slightly less strength. However, the RSI 14 and the moving average 14 show us something quite interesting. As price has been moving up during this period, we can see there's a slight divergence here, and in fact price has moved down slightly over the last few weeks, and the RSI has crossed through its moving average 14, this green line, and is starting to move down somewhat significantly on a longer term chart. This might be a short-term pullback, we can't tell right now, but I would suggest quite a serious signal is a cross back down through this 200 dashed line, this 200 moving average. What is also interesting to note is that if we have a look at Fibonacci retracement, I'm going to plot a Fibonacci line here using Telechart. I'm going to select the Fibonacci tool, and I'm going to take Fibonacci line from the top here in the end of 2007 and draw Fibonacci down to the bottom in 2009. Now here you can see in this turquoise color the Fibonacci retracement is plotted on the downtrend, and you can see price has moved from this line here, and you can see we've got the retracement, the first bounce, and it moves steadily through this Fibonacci line, and then bounces directly off the Fibonacci line, then moves directly through to 2 Fibonacci lines further, and then retraces back to this line here. So if we look at Fibonacci, you can see here this is the 0 line here, and we look at the 38.2 line here, the 50% line here, and the 61.8% retracement line here, and 100, of course. This is where we start to plot from. So to recap, the price moved up, and the most significant lines potentially are the 38.2, the 50 and the 61. Price moved steadily through the 38.2 line right here, continued up, found resistance here at the 50% line, moved back down below the 50% line, very close to 38.2, and then moved up and bounced directly off the 61.8 line here, moved up, found resistance again right here, and has now exceeded that. So you would think actually the next logical point would be either to move up to here for an all-time high, and the market's looking very resistant at the moment, or to move down and find some sort of support here, or continue through and find support here and then resistance here. So this helps you visualize the market on a longer term period here. So Fibonacci is quite nice, it's worked very well here. So if we look at the longer term view, we would say, okay, as an investor, this is not a bad time to be getting into the market according to the 200 moving average. Of course, we might be reconsidering that opinion should there be any significant break of the 200 moving average on a weekly basis right here. Now let's look at a daily chart, and we can see here the 200-day moving average. On this chart you can see actually that that price is actually clearly through the 200 moving average, moving up very strongly here, and we can draw a trend line along the lines of this. Looks a pretty good trend line to me. This has actually recently been broken there, and as we saw in March, there was a significant devaluation of the markets, obviously aligned with the crisis in Japan. However, the market is starting to recover, moving up. We can see here we've found support at this level, and price has just recently moved up through the 10, 20 and 50-day moving average here. If I zoom in here, you can see this much more clearly right here. And what is important to note here, if we look at RSI, RSI has been showing quite the divergence, which is very interesting. If I show you this here, this is what I'm always trying to get the message across here. As you can see, the RSI here has been moving negatively, diverging negatively here with the price. Price during this time period has been moving up, and then we have seen the price actually take a dive here, and RSI had a spike here at the top, but then continued to move down, move below its 14 moving average, and right here you can see that the 14 period RSI has moved up through its own 14-day moving average right here, and we see a spike in MACD here. So it could potentially pave the way for some more positive moves by the market. Over the last few days though, we have seen that the market itself has been stalling. I'm going to zoom in here so we can see that the market has dropped considerably here. However, we've had an excellent run just in the last 2 weeks, which has confounded many technicians, but you can see MACD here is starting to move out strongly, and the RSI is moving from an oversold position, crossed its 14-day moving average, and is starting to move up. So things could be looking up. Don't hold your breath. There is the employment report coming out today, and we'll see how that affects the market. So I hope that's given you some good ideas on how you can use longer term charts to help you make decisions on when to be in or get out of the market, depending on your view. And it's always good to have a look on a weekly time frame over a period of years. Use a 200 moving average as a baseline to help you guide your investment decisions. This is Barry Moore for LiberatedStockTrader.com. If you're interested in the free stock training course, then feel free to register at the site. And of course, we have the Liberated Stock Trader Pro training available, and that is at liberatedstocktrader.com/pro. Good luck trading, and may the market be with you.